Hello everyone, Julius de Kempenaer here with a new video on sector rotation, RRGs and markets in general, I'd say. I'm a little bit late this week, recording this on Tuesday after the close, 15th of October. And the reason for that is that I'm trying to make up my mind what's going on in this market. We've seen the break. The break is absolutely there. And let's just dive straight into what's happening with the S&P 500, or at least the way I look at it. This breakout higher out of resistance, definitely there. We had that divergence, we talked about that, and it looks as if this in the RSI is resolving to the upside. It's unusual, but happens, and that would vouch for strength in the market, which is what we see. Why am I still not super bullish? I'm not super bearish, but I feel that we need a little bit more of a consolidation or a corrective move to get some new fuel. We've had quite a rally already, and if I look at all the circumstantial evidence, I think is the best way to describe it, what's going on in the markets, and we'll talk about that later in this video. I have a problem, or I have a hard time being or becoming super bullish on this market. Maybe I'm totally wrong. It's very well possible, but I find it hard. And if I'm in doubt, if I'm not sure, if I don't get enough pieces of the puzzle to fit, I'd rather stay on the sideline or do some stock picking and find some isolated trades rather than being fully invested in the market. I think that's a little bit of a nuance here, because even when the market is going sideways, or even when the market's going down, there's always pockets where you will find good trading opportunities. Not necessarily talking about that in these videos too much, but just to make you aware that I'm not predicting any crash scenarios or anything like that. I'm also of the opinion that crashes never start from the top of the market. There's always a prelude to that, and we don't see that. However, I do see risks, signals, other elements that keep me alert and withhold me from diving fully into this market. This is the weekly chart, didn't change. That RSI is resolving to the upside. It's a bullish sign, there's no doubt about it. If I go to the daily version of this chart, we see that wedge pattern. We broke out yesterday, and today we're breaking back down here, and we're putting in, it's a new peak in the RSI. It's marginally higher, I would say, and we're not taking out this peak in the MACD. Not super bullish in my opinion, and you can see that the angle of the lows is steeper than the angle of the highs. It's also not a nice trend channel. So what I did is I started to and I still am trying to figure out where I'm wrong or what I'm missing. So I'm trying to put together pieces of the puzzle and basically trying to make up my mind. And we'll do that using the sector rotation model. I realized that we didn't speak on the sector rotation model for quite some time here, so I thought it was a good occasion, a good time to update that model and see if we could get any actionable, strong signs, strong information from that model. The other thing that I did is was looking at volume. Volume can sometimes give you good indications of what's going on. And if I look at the volume pattern over the last 2-3 months, what I noticed is that so here's the peak. This is the peak here in July 2024. So this is a weekly chart. And then we have 4 weeks where the market's going quite steeply down. And you see that the volumes are rising in that decline. Now, mind you that the rule is that volume should increase in the direction of the trend. So if the market's going up, what you want to see is volume rising on the up weeks or up days and declining in the corrective days or weeks. So if this is, well, it is an uptrend in terms of price, but it's not confirmed by volume, because what you see here is that volume is rising on the decline. So that is a counter trend indication. And then when the market goes up, here, you see that volume is declining. We got one big spike here, that's on the breakout, so that's a good sign because you want to see expanding volumes on the break. But then on the follow through, first of all, it's not a real follow through, it's not a super aggressive rally. It's going higher, but not at a very high rate of change. And again, you see that the volume over the last 4 weeks is declining. Now that last week is obviously only 2 days of trading, so we can't really judge anything on that. But the last 4 weeks, 3 weeks, so 1 to 3 weeks, volume is declining while the market's going higher. Again, it's not a very supportive volume pattern. Just want you to keep that in mind, or I keep it in mind. Now let's take a look at, or if we can find any information from the sector rotation model. Now the sector rotation model that I like to work from is the one that is based on Sam Stovall's S&P Guide to Sector Rotation. You can find it on the perf charts, on the page with the perf charts, and then if you go to the US sectors and scroll down, you will find the theoretical sector rotation model. And what it does, it shows you the economic cycle, that's the blue line. It shows you the theoretical market cycle, that's the orange line. And then across the top you have the sectors that are outperforming during that part of the cycle. And then, at least as important, below the chart are 4 economic indicators that help you find or pinpoint in which phase of the economy we are at the moment. And I have set up a chart list, which I will share in the comments of this video. It's a public chart list, so you will be able to load it to your own system if you're a Stockcharts member and look at these charts. They're quite long term, so you don't have to look at it every day, but you know, I like to look at it at least once a week, twice a week, and then just get it in the back of my mind. What we're going to do is we're going to go over these 4 economic indicators, make an assessment of where they are, how they're behaving, and then plot that on that table below the chart, and then we go in an RRG and we're going to make an assessment of the sector rotation and see if we can match that across the top of that chart, and hopefully at the end of that exercise we'll have some meaningful information. So let's go. The first one is the Consumer Sentiment Index, and what we have to do is we have to figure out whether this move here is reviving, rising, declining, or falling sharply. Now, it's not falling sharply, it's not declining, and I think you can have a discussion whether it's rising or reviving. If this is the decline, we are reviving. Or if you look at this, we are rising. So I've put it somewhere in the middle between reviving and rising, which would position us between a full recession and an early recovery. We'll plot that later on the image itself, so it becomes more visible and speaks more volumes. The second indicator is industrial production. I think that's an easy one. That's a flat. That's definitely a flat. And that means that the market is, or the economic cycle is in full recovery. That's probably the easiest one of the 4. Then interest rates, that's a tough one, because we're not bottoming out, We're also not rising rapidly, not anymore. So if you follow the sequence here, I think we're probably, it looks like we're peaking, like looks like a double top, and we're putting in a top, and we're going to see a little bit more of a decline if I analyze this chart here. So I labeled it as peaking. So according to interest rates, the market or the economy is peaking. And then the last one is the yield curve, which is interesting because after a very long time this uninverted itself and it's now back to normal. It's not steep. Steep is this. Steep is when you have a very high reading on this thing. So I think the only one left out there is normal. So that would mean that the economic cycle is in a full recession. Again, we're gonna put that all in the image with some coloring stuff later on and try to make up our mind. So for now, we're gonna go to the sector rotation. Now, to pinpoint the current position of the sectors and make an assessment if they are outperforming or underperforming and color code that on the sector rotation model, we're going to use the monthly RRGs because this is a longer term. These cycles are pretty long term. So I'm going to use monthly RRGs. And I'm also going to use the equal weight sectors. So I want to take away that big market impact of those mega cap stocks that influence the, a single stock or a few stocks can influence the rotation of a sector and it doesn't really reflect what's going on in the economy. I think that the equal weight sectors are a better gauge to fill that sector rotation model. So here's that monthly RRG, and let me blow that up a little bit for you. Now the technology sector has rolled over, so and it's at a negative heading, and these are long-term rotations. So the fact that it is in the leading quadrant and far on the right, but it is moving down. It's at a negative heading. So I'm gonna label the technology sector as over its top from a. This is all relative, mind you. This is all relative. So it's definitely not a call that technology is going down. It is a call that technology. And looking at this tail and looking at this rotation, and if you just look ahead and would plot forward, I can see at least 2 or 3 months of continued rotation towards and into the weakening quadrant. So that for me is a sign that the technology sector is over its top from a relative perspective. At least in the near term, it's going to some sort of a corrective move in relative terms. So I'm going to label that. I'm going to color code it orange. You'll see it on the image in a minute. I'm going to color code it orange. It's not going up anymore. It's a warning sign for the technology sector. If we go to financials, that is moved into the leading quadrant at a pretty high momentum level. So that all looks good. It lost a little bit of momentum here, but it's still moving higher on the RS ratio scale. So that is an outperforming sector for me at the moment. If you look at real estate, that's doing really well. So again, looking ahead or trying to look ahead and make an assessment, I think this is a sector that could continue its outperformance for the next couple of months. So that's an outperforming sector. If you look at utilities, it looks the same. It moved from lagging into improving. It's pretty long tail, meaning that there's quite a bit of momentum power behind this move. So that's also, it looks to be an outperforming sector at the moment and in the coming months. Here is RSPC. What's that? That's communication services. I always need to look at the ticker symbols for the equal weights. They're not in my head as the cap weighted stuff. So communication services, again, it's inside improving, but it rolled over and it's losing momentum. So that just like technology, although it is on a different spot on the chart, I have that as a warning signal, as a end of a move, losing relative strength, losing relative momentum, rolling over. Not necessarily super negative yet, but be careful with it. Here is industrials, rolled over, just like technology, an orange like warning signal that the best of that for that sector, the best relative performance for that sector is over, at least for the time being. And here is discretionary, same story, rolling over. They went through a very good period, they went through a very strong relative performance, but they're rollover. So technology, industrials, consumer discretionary, communication services to a lesser degree. But here also, that sector is a warning signal. I don't see this, again, this is a monthly chart. I don't see this hooking back up, and next month when we talk about this thing is all of a sudden inside the leading quadrant. It'll be very, very unusual. So consumer discretionary, also caution, moving away from being a relative outperformer. Here is energy. No, staples, sorry, this is staples. Lowest reading on the RS ratio scale, but starting to pick up. It came out of a long period of underperformance, and it is not super strong, but I've labeled it blue, so I use orange, blue, green and red to indicate where we are. And I've labeled this as a blue sector. It came out of red, it was very red, it came out of red and it's now starting to improve. Not necessarily immediately an outperformer, but it is starting to pick up relative strength. Here is energy. That is a quite similar type of thing, although this has a little bit less of upside momentum. And looking at the chart itself, I've labeled this as a negative sector. Basically, and it's a very subjective call. I totally realize that. Why would I call this blue and improving, and why would I call energy a negative one? Well, because staples has already made a large move, went through that decline and is now getting out of that. And energy, and also if you look at the price chart of it, I think the energy chart looks less promising than the staples chart. And it has just entered here, and it can absolutely move further on the RS ratio scale. Again, it's a pretty subjective call. I absolutely know that, and I realize that. But that's how I judged it. So energy is an underperforming sector for me. Here's healthcare. That's definitely an underperforming sector. It's inside lagging. It picked up a little bit and it now started to move to the left again. And as you can see, there's, if you look at, this is like the normal range. There's quite some space to the left where it can move to. So I'm leaving healthcare as an underperforming sector as well. And now we've got materials, and materials is picking up. It's a very short tail when you compare it to staples and some others, which means that it is still in a relative downtrend, but it's picking up. It's increasing its velocity, so the last node is actually quite large compared to the last months, making it an improving sector for me. So I've labeled materials as blue, as potentially improving there. And then that was it. Those were all those sectors. And what we're going to do now is we're going to bring in that sector rotation model and color code the sectors and the economic indicators. Now here's the sector rotation model with my annotations. Let's see what we can make of this. And let's start with the economic indicators. They're all over the place. We got consumer expectations between full recession and early recovery. We got industrial production, which was flat, which is absolutely a full recovery. Interest rates, I think the only feasible position is peaking, which would mean an early recession. And then the yield curve is back to normal. So 4 indicators, 4 different positions. And if you say reviving, then full recession would get the majority of the votes. If you say early recovery, then we're totally flat out. So this is not going to be super helpful, I think. The only argument that I can make or see is that we're moving through, because this is a cycle, this is a sine wave. So we're moving, so some of these indicators are moving to the right, and that would mean that the yield curve is normal. That is a given. I think this flat is also a given, and this peaking, this is doubtful. I really don't know how to if this is the correct call. So my bet is that we're in the phase, so we're not in the early recovery. So we're not here. I think that's the most important conclusion. So we're full recovery, that will mean here, or early recession moving to full recession. In any case, we would not be in this phase of the bull market. We could be either here. We're also not in a bear market. That is also for sure. Now, if we bring in the judgment calls on the sectors, you can see that there is a concentration of greens on the right-hand side, which would argue early recession. It also argues bear market, which it is not. The rollovers are on the left, and the negatives are here with some improvements here. So these would eventually turn green, and these would probably eventually turn red, which would mean that we're moving, so we're probably here trying to figure out whether we are near a peak or whether we have rolled over. But the market has not done that. And do you see my problem? This is, if I look at the relative position of the sectors, if I try to figure out where we are based on the economic indicators in the sector rotation model, there is not a very clear-cut signal or assessment possible. Neither is it from the current sector rotation perspective. And the market's going higher. So the market's not matching, what we would argue to be the theoretical framework for a market that's moving higher or in a full-fledged bull market. And that is my problem. I don't see that we are in a full recession, early recovery, which matches with a market bottom and a bull market. Well, a market bottom is a problem because we're at the market top, so we're definitely not at a market bottom. Are we in a bull market? You could argue yes, but the rotational behavior doesn't match with a full-fledged bull market. It also doesn't match with a full-fledged bear market. And that's what makes me very, very cautious. And it holds me back from going all in, bet the farm, all of that. Call me crazy. Maybe it's, a lot of people talk about FOMO, and I don't have the FOMO virus. I am perfectly fine with missing a bit of the upside when my analysis and my assessment indicates that there is risk, rather than going all in and getting hammered down when we will get a corrective move. So All in all, the market continues to send me mixed signals. The sector rotation model is not lining up enough to my liking, at least to become super bullish and follow the market higher. I am aware of the breakout and the market going higher, so this is not calling for a crash or a decline, but I do see a lot of signals, elements of information that make me cautious. Sector rotation model, the economic indicators, the sector positions, the volume profile that we currently see, and a market that broke higher but is not aggressively rallying. Maybe not yet. Anyway, I wish I had some better and some more pronounced and backed up analysis with a clear directional move, either up or down. I don't care. I mean, that's both fine, but it isn't there. So I remain cautious and will make a new assessment next week. Thank you for watching, as usual, and hey, let me know in the comments whether you feel I should just be following price and forget everything else and just go with the flow and ride this market higher, or do you agree with some sort of contradictory information coming to us from various angles? I'd love to hear your thoughts. Thanks for watching, and I'm looking forward to seeing you again next week, same time, same place.